Sainsbury's reported Q1 total retail sales of £9.15 billion on 30 June, up 2.7% year-on-year, and the shares jumped 2.4% on the news. Grocery sales rose 3.6%, beating the 3.4% analyst consensus, and online grocery surged 12.5%. On the surface, this reads as a clean beat from a retailer that has been winning footfall against Tesco and the discounters. The provisional answer to why the shares moved sits not in the headline number, but in the split underneath it. Customers are choosing Sainsbury's more often, and the CEO cites the very same data point. More people are choosing Sainsbury's for their big weekly shop. But the 2.7% total sales rise conceals a structural problem that the 3.6% grocery line obscures. General merchandise sales fell 6.3%. To clothing dropped 2.1%. Argos revenue declined 0.5%, even as volumes there rose 2.2%. That last figure is the bottleneck. The same customers who are visiting more often are spending less per transaction every time they do. Sainsbury's is winning the footfall war while losing the revenue per visit war, and the two are moving in opposite directions inside the same quarterly update. The Argos result is where the standing consensus runs into its buried assumption. The consensus read on Sainsbury's has been that grocery momentum, Nectar prices, Aldi price match, fresh food outperformance, is building a platform of stable earnings as the cost of living pressure eases. That logic requires volume and revenue to move together. They are not. At Argos, volumes rose 2.2% as customers bought fans, large-screen TVs, and paddling pools ahead of the World Cup and a May heatwave. But Argos revenue still fell 0.5% because customers systematically chose lower-priced items within those categories, and average selling prices compressed. Hargreaves Lansdowne flagged this directly. Sainsbury's is more exposed to general merchandise than its peers through its ownership of Argos, and the trend has worsened over the first quarter, with sales growth slipping into negative territory. Jefferies, while calling the print a slight beat, cautioned that the Argos volume composition may reflect a shift towards lower margin categories, meaning forecasts are unlikely to move much. This is the reversal card. Sainsbury's winning on choice and footfall is not the same as winning on earnings per customer. Shore Capital is more optimistic, arguing that the bottom of the $975 million to $1.075 billion profit guidance range may yet be raised if Q2 benefits from warmer weather. But Shore is the house broker. Its Reed and Jefferies diverge on exactly the question that matters: whether trading down shoppers translate into profit expansion. Goldman Sachs cut Sainsbury's from buy to sell earlier this year, and that rating has not been reversed. The pool holds two distinct analyst camps reading the same Q1 data in opposite directions, and the pivot variable is the Argos average selling price trajectory, not the grocery share gains. The holder and the watchlist candidate face different versions of the same unresolved question. For the holder, the guidance band is unchanged at £975 million to £1.075 billion underlying operating profit. That is either a floor with upside if Q2 weather and World Cup momentum lift average selling prices back up, or a ceiling that compresses if trading down deepens into autumn. The CEO acknowledged that, quote, inflation is still coming through the supply chain. Not at the 9% pace the Food and Drink Federation initially warned, but present. Shop price inflation stayed flat at 1.2% in June, per the British Retail Consortium, the same as May. If that number rises through the summer, driven by Middle East energy costs feeding into fertilizer and freight, Sainsbury's faces a cost push at the same moment that consumer confidence is too fragile to pass it on. The Sun reported that Sainsbury's is still accepting bids for Argos as part of its transformation plan. An Argos disposal would remove the drag, but timing is uncertain, and any bid process takes months. The verification anchor for both camps is the next BRC shop price inflation print in August, which will be the first signal of whether the June flatness held or reversed. A second or third consecutive flat or falling read would support the thesis that trading down is stabilizing and margins can recover, making the stock an opportunity for the watchlist candidate at the current range of 300p to 360p. A rising print, combined with unchanged or falling average selling prices at Argos in Q2, would validate the Goldman Sachs sell thesis. The grocery beat is real, but insufficient to offset the Argos structural drag and an incoming supply cost wave. Sainsbury's becomes a trap not when the grocery line weakens, but when the cost line rises faster than the volume gains can absorb it. The holder watches the BRC August print. The watcher enters only when that print confirms the trading downtrend is turning before cost pressure arrives. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.